Good morning. My name is Cindy Wishart, and I'm the Marketing Manager for ERCOT at GDF SUEZ Energy Resources. At this time, I'd like to welcome everyone to the GDF SUEZ Energy Resources webinar, The Transformation of U.S. Energy Markets, with Andrew Weissman. Weissman is the Editor-in-Chief and Publisher of Energy Business Watch, as well as a Senior Energy Advisor at Haynes & Boone. We'll conclude the webinar with a question and answer session. All have been placed on mute to prevent background noise. Note that today's web conference is being recorded. We have our audience in this webinar session. Participants include energy buyers from small businesses all the way up to the Fortune 100 companies. Additionally, we have many third-party consultants and brokers on the line with us today. We're excited to have over 350 participants joining us this morning. Again, I want to mention that throughout the presentation, we invite you to submit your questions. To present a question about the presentation using WebEx console, click on the Q&A panel icon. On it, you should see a Q&A window where you can enter questions or comments. Select All Panelists from the Ask menu. Type and click the Send button, and your questions will be in the queue. We will ask questions at the end of the program as time permits. A copy of the recorded presentation will be sent to you after the webinar. If you experience any technical difficulties during today's event, please press *0 on your phone keypad to be connected with an operator, or submit any technical issues or questions by using the chat panel at the bottom corner of the screen. Or if trouble with joining the WebEx, please contact 1-866-229-3239 and select 1 on your keypad for WebEx technical support. Let's begin today's presentation, Transformation of the U.S. Energy Markets, with Speaker Andrew Weissman. At this time, I'll turn it over to Andrew Weissman.
Thank you. I really appreciate having the opportunity to speak with all of you today, and as Cindy indicated, we're going to try to take some questions now, and if you have others after the program is over, please don't hesitate to email us. What I'm going to do today is that I'm going to try to give an overview of the really fundamental changes that are occurring in the way the U.S. electricity and natural gas markets are operating. Let me start, though, with a very concrete observation point, and that is timing of market procurement is always a really important issue, and the bottom line in terms of the way, I think, at least the most likely way that the market is going to evolve is that I think it's going to be sometime over the next 3 or 4 months that we might see the best buying opportunities for the next 12-month cycle. I think it's going to play out a little bit differently than it has this past year. And we can go to the first substantive slide. Finally, it's really a kind of a fascinating period because what we're seeing is really a profound change in the way in which the electricity and natural gas markets are operating. I think it's a permanent change in that it essentially changes the rules of the game. It will change the rules of the game, at least for most of the next decade. And I think, therefore, it's something that all of us have to try to understand as thoroughly as we can, because the factors that have driven prices in the past are not the price factors that are going to drive prices in the future. These changes are occurring incredibly quickly, and we're going to talk in some detail about exactly how the market is operating now and how it differs from the way it's operated in the past. The differences are really deep-seated. We're seeing some fundamental changes in the way the entire electricity grid is being operated, and it's having major implications for both electricity and natural gas. And my own view is that essentially we may well be seeing something of an asymmetrical market where prices probably will go higher than they are now at some point over the next year or two, but we're not going to be exposed to the kind of good news is that we're not going to be exposed to the sort of major increases that have occurred in the past. one important caveat that I'll get to relates to the regulatory policies for providing incentives for new generation. That's the one potential trouble spot, really kind of huge trouble spot on the electricity side. But I think while with that exception that we may see something of a ceiling, that we also are definitely going to, I think, continue to see times when prices will dip, and at least in an ideal world, none of us ever expect to be able to catch the timing perfectly, but I think what's going to be possible is we've worked hard over the last year to develop a set of analytical tools in order to be able to understand how the new market is working, and I think with those tools we now have some really pretty good visibility as to when the best buying opportunities are likely to arise, and I'll speak about those too. And if we can go to the next slide now. Just a word, I think everybody is thoroughly familiar now with the revolution, and essentially, I mean, the good news associated with it is that it is really a profound change. What the graph on the right is showing is basically, if you look at it in terms of BTU equivalents, in terms of the natural gas and natural gas liquid and oil resources that have now become accessible at relatively attractive prices, they're enormous. In BTU equivalent terms, it's probably at least 3 times total Saudi oil production over the last 20 years. We've never seen anything like this. And the reason we're seeing this basically is we're tapping a different resource than we tapped in the past. Essentially, for the whole history on the natural gas side, basically we've been living off of leakage. Basically, the natural gas that we've used has come from rock formations that were much deeper, and natural gas we've used is essentially the gas that's over time percolated up from these rock formations that are lower down and happen to percolate up into an area where the rock formations trapped it. And so when we talk about drilling for conventional natural gas, essentially we're drilling to look for gas in those situations where amounts had percolated up and been trapped, and we could get them by just drilling straight down. What shale is it's those formations that are deep down where the conventional gas came from. And most estimates in terms of what's still down there, it's probably 95% or more of the natural gas that was originally in place. So enormous resource, and we're no longer limited to extracting it in the particular locations where there happen to be rock formations that trap the gas. It's everywhere. And my own view is that essentially that 5 years from now, 7 years from now, 10 years from now, we'll look back and say, boy, you know, we didn't even really begin to understand. 100 years of supply sounded like a lot, but actually, as the technology continues to improve and we understand the resources better, I think it's going to turn out to be even better, and that's really exciting because the U.S. now already is the lowest natural gas producer of any industrialized country in the world, and is one of the lowest electricity cost producers. And so I think if we understand the dimensions of this resource and what it can do in terms of opportunities for manufacturers in energy-intensive industries and in terms of keeping energy costs low for the whole U.S. economy, it's one of the most important changes that have occurred in our lifetime. Just with that as general background, as you'll see, I think the dimensions of the resource and the speed with which it can be developed are important factors, and so I wanted to start by giving a little bit of overview there. If we can move to the next slide. In terms of understanding the new market, I think all of you are aware that in the end, for a long time now, in the high price periods of the year for the electricity market, it's usually been natural gas prices that have been driving that. There are exceptions. This is ERCOT. The black line is electricity prices, and what they show is whether there's adequate capacity is a really important thing, basically. And so the spikes are the time where the problem was not having enough generating capacity. In terms of the rest of the year, though, even it's really, natural gas prices have come way down, and therefore so have electricity prices. And that's why we're going to focus on what's going to happen on a continuing basis in the natural gas market. And what I do now is that I want to try to contrast how the market worked in the last decade with how it's working now and how it's likely to work in the future. This is going to be good news, but I think it's important to understand the changes that have occurred because they're the key to understanding what might happen in the market going forward. And starting point, this one slide, in a sense, is sort of academic in approach in that it's just kind of laying out four kind of core aspects of how a market is functioning that are really the market drivers that determine whether prices are going to stay stable. And there are really at least four factors that are particularly important. The first one that's listed there is obvious. You have to have the ability to produce enough fuel so that both in the electricity market and in the natural gas market, adequacy of fuel supply is not an issue. The second, which is related in a way but is particularly important, is not just can you produce enough to meet the total demand, but also if the market starts to tighten, how quickly can you expand supplies? And that's an extremely important characteristic. And a third for almost any market is basically are there other products that can be substituted for the product that we're focusing on. And of course, in the natural gas market, that's really a question of fuel switching. And the fourth that is particularly important for the natural gas market is, do we have adequate storage? And if we can go to the next slide, Ginger, what I'm going to try to do is to review really quickly, what happened in the last decade that caused a disaster for all of us. And all of us remember very clearly just how steeply prices spiked. And I think on the user side, we all remember how recent it was. I guess we're in late September of 2012. It was only July of 2008, just a little over 4 years ago, that price spiked to 1357 million BTU on the peak day. Why did that occur? And what's different now in terms of why it occurred? If you look at those four factors I listed, we were in a heap of trouble on all four of those characteristics of a market. If you look on the left of the slide, what that's showing, that's just a simple point, that if you look that shows where we got our incremental electricity supplies from 1979 through 1997. What you'll see is the two colors that dominate are the black and I'm a male, so I can't name the color correctly, but I'd say pink is probably a better name for it. But and those are coal and nuclear, and what you can see is that we got almost all our incremental electricity supply until 1997 from coal and nuclear. We really weren't stressing the natural gas market much at all. But then if you look at the graph on the right, changed really pretty abruptly in the late 90s. And what happened, the rate of coal and nuclear was really because after the oil price crisis in the 1970s, we wound up with a huge amount of surplus generating capacity, and that gave us an opportunity to basically meet incremental demand by just using the plants that already were in the process of being built during that time period. But by the late 90s, we finally had exhausted that capacity reserve really pretty much in most places around the country at more or less the same time. And so if you look at the graph on the right, you then see this enormous blue spike. And what this graph shows you, it's to scale, is all the generation additions that were made in the U.S. over the last actually 60 plus years. And that blue spike is the generation that was added between the late 90s and 2005, and it's blue because it's almost all natural gas, and what that did is that it locked us into a situation where during the last decade, really pretty much the only way we could meet incremental electricity demand was to use more natural gas. So if we look at we built in this enormous source of increased demand. If we can go to the next slide, please. And unfortunately, what happened, and sort of one of the major root causes of the crisis of the price spikes in the last decade, is that just when that happened, we basically ran into a wall where we'd been drilling the conventional natural gas that generally was near the surface and happened to be caught in these traps for decades. And unfortunately, just at the same time, we found ourselves as a country to use a lot more natural gas for electric generation. We reached an inflection point where the number of attractive targets went way down. What the graph on the left is showing is that the production per well started to go way down. In response, the natural gas industry was not really the problem. They were very, very aggressive in ramping up drilling, and unfortunately they could barely keep up with the decline in production per well, and so we wound up in a situation where we had this tremendous built-in, unavoidable increase in demand on the power sector, and basically we couldn't supply it at all. We couldn't increase the supply at all. So that gave us a huge problem all in and of itself, and then we had two more problems. If we can go to the next slide. The problem was, if we back for long periods of time, prior to this crisis period, actually we had a lot of ability. There were a lot of industrial users, large industrial users, who literally I used to put on programs in the early part of this decade, and I learned through the attendees at my programs. Basically, you had all these industrial boilers where the manager got up in the morning and decided which fuel he or she was going to use. And that was, if the natural gas market started to tighten, it gave us a way to quickly substitute another fuel and reduce the pressure on the natural gas market. And that's really why historically there was a huge correlation between natural gas and oil, because basically you could switch back and forth, and had the huge advantage from a customer standpoint that it tended to protect against big price swings for natural gas. And what happened again, a lot of this, what happened last decade is just that the timing worked out. What happened is that right about the same time this was happening, there were some Clean Air Act restrictions. It had actually been enacted 13 years earlier in the Clean Air Act amendments of 1990 that finally kicked in. And they kicked in right in the early part of the decade, and they forced retirement of an awful lot of the industrial boilers that used that used oil, and it also forced shutdown of a lot of power plants, particularly in the Northeast, that were still burning oil. And so, even in 2002, 2003, the ability of switching as kind of a safety valve to reduce the pressure on the natural gas market when the market tightened started to go way down, and by the middle of the decade, it essentially disappeared. And so we didn't have the protection of fuel switching to help moderate prices. And if we can go to the next slide, the last huge piece of the puzzle is that we learned in the price spike in the winter of 2002 and 2003, we learned that when we no longer had this ability to use oil and to switch between fuels, that essentially we didn't have enough storage for the winter. In the winter of 2002, 2003, we actually came perilously close to run out of natural gas in storage in a winter that was actually only 1.7% colder than the historical norm. So those were the four conditions that we have, and if we can switch to the next slide, when you put all those things together, what was sort of inevitable, and it was a disaster. What happened, the main driver during this period basically that if you have an intrinsic increase in demand in the power sector and you don't have the ability to increase supply, you're between a rock and a hard place. And the only way for the market to balance basically is for prices to go up and up and up and up until they've destroyed enough demand, until they've driven enough sensitive users out of the market so that supply and demand finally balance. So during the last decade, the price for natural gas and therefore the derivative price for electricity were not really being set by the marginal cost of supply as much as they were being set by the demand destruction curve. This issue of how much demand do you have to drive out of the market in order to balance supply and demand. And alone was enough to lead to a disaster in terms of prices going up, and then it was worse. It was worse in part because we didn't have the safety valve from fuel switching, and then it was particularly worse because we all learned there was risk that prices could go absolutely literally through the roof. We had even a close to normal winter because there was a risk that there would be enough in 2002, 2003 on the worst day. Prices at Henry Hub interday got up to $32 a million BTU. And so the market reacted rationally to that as well, and it built a big risk premium into the price of the winter month futures contracts so that users could protect themselves against the price spikes by buying futures. And that premium, that risk premium in turn rippled through the whole 12-month strip and probably added another $1 or $2 beyond what we would have seen from the demand destruction curve alone. And those were the drivers. Those were the concrete factors. It's not a mystery as to why prices went up. Those are the four causes. What's changed, if we can go to the next slide, is everything. All four of those factors have been turned on their head. And first of all, where the good news is, but also it's important to understand why, what means, what's occurring as a practical matter, because it is a totally different market and it works in a totally different way, and that's what all of us need to really have our arms around as well as possible to understand what's going to happen with prices in the future. For openers, in terms of the first two issues, do we have enough supply, and if the market starts to tighten, can we increase supplies of natural gas quickly enough so that we go back to stable prices? The answer is we have way more than we can use. And that's the story of the last year. But we also, just as significantly in terms of what's going to happen in the future, with the ability to expand supply at an incredibly rapid rate. So if you look backwards a little bit, over the last 4 years, we have increased U.S. production by 10 BCF a day. 10 BCF a day, excuse me. We've increased net supplies by 10 BCF a day. We increased onshore production by even more than that. And twice, if you look back as to what happened in the last decade, the total increase in power sector demand that caused prices to go nuts in this decade was a gradual increase of 5.4 BCF a day over a 10-year period. If you look over the last 4 years, we have twice added 5 BCF a day to U.S. production in 12 months. And right now, one of the things that's going to affect the market going forward is that in the next 12 months, we're going to add roughly just a little under 4 BCF a day of additional supply in Marcellus Shale alone. So we have this enormous ability to increase supply, and it means whenever prices start to tighten in the future, there's good reason to think that the supplies can be increased. If we can go to the next slide, so the fundamental change that's occurred in the market, the result of that is, as I think probably all of you are aware, but I want to drill down to, is that rather than being in a situation where it was a demand destruction-driven market, now basically in a situation where if essentially we had prices of roughly $4, let's say, we would have way, way, way too much supply. And so the way the market has balanced, essentially the exact opposite. Rather than prices rising to reduce demand, the price of natural gas has fallen and fallen and fallen in order to induce sufficient additional demand to balance the market. So it's that dynamic that's been driving the market. I mean, today the price for the front month natural gas contract is in the 270 to 280 range. If you ask the question, why is it at that price level? And the answer is that for the market to balance now, we have to induce sufficient additional demand to absorb the supplies that are available now, and the price at which enough natural gas-fired generation is increased and enough coal generation is ratcheted back for the market to balance is right around 270 to 280, and that's exactly what's been driving the market more or less continuously for 2 or 3 years now. So this, what's happening at one level. If we can go to the next slide, and what it means in terms of the other elements. We've had 2 other things if we go back to that original 4-item checklist, and one is that now we're back to an era where we have fuel switching capability. We have it in spades, and that's really important, and it's really good news, because essentially the use of coal-fired units is going way down, but the majority, there's a lot of coal units retired, but probably 85% or more will continue operating. But those units that continue operating, most of the time will operate at much lower capacity levels than they've in the past. So what will happen in the future is that when the market starts to tighten, one thing that's going to happen is that we're going to start to reduce natural gas use on the margins and substitute heavier use of the coal plants. They're going to move back to the utilization patterns that they were used at historically. And that's going to be really good news because it's going to keep natural gas prices from rising. And then there's another factor that's even more important that's going to keep natural gas prices from rising too steeply. And that is, we had a storage deficit 10 years ago. Now what we've done, we really didn't have a true reserve. We really didn't have any kind of cushion 10 years ago. We really had a storage deficit. Now we've added 700-800 BCF of new storage capacity. We don't have to worry about what happens in the winter anymore. We have a cushion. And that adds a further strength to the market in terms of keeping prices stable. And the strength is essentially, if we think through what happens, the market tightens. We have this tremendous ability. We have the buffer of fuel switching to help prevent prices from rising much. But if the market tightens enough so that storage starts to draw down, we have a real cushion that's going to give us some time. And in terms of replenishing the drawdown of storage, we can increase. I was going to clap, but not too loud because I don't want to startle any of you. We can increase supplies really rapidly and replenish storage. So we've got this dynamic setup that I think is really going to be very helpful in terms of putting a lid on prices. It's not going to be where we are now, which is why I do think that this is a time to look carefully at locking in supplies, but it's also not going to go through the roof anymore. And go to the next slide. So those are the fundamental changes between the market. And what I mean is that in terms of the way markets are functioning, is that it's this that there's intense competition between natural gas and coal, and that's going to continue forever, basically, certainly for the next 5, 10, 15 years. And that competition is going to limit increases for natural gas and drive down prices for coal. And the cheaper it is to use the coal units, the lower electricity prices are going to be in the hours when the coal units are the marginal source of supply. And the lower natural gas is going to have to fall in order to absorb any excess natural gas in periods in which there's excess natural gas. And so that's a permanent change, but it also does mean that we're going to need new electric generation, and that's the one thing that scares me. And that reason for that fundamentally is that particularly in the deregulated markets, as I think probably all of you are familiar, all of the markets have rules now that are intended to provide adequate incentives to build new generation. The problem is that there are two sets of rules. There's Texas and the rest of the world. And Texas, as probably all of you are familiar, relies on energy prices alone. The notion is that a generator will have adequate incentives to build generation, because the market will work, and it will set the clearing price for energy high enough through periods in which capacity is tight that a generator will be able to earn enough during those hours in order to cover all of its fixed costs and make an acceptable rate of return. And that's the Texas model. And then the rest of the country has what's called the capacity rights model, where the load-serving entities have to lock in capacity rights. That's sort of a paper right in a sense, because it's not tied in a complete concrete way. But the capacity rights are auctioned off, and the theory is that if load-serving entities have to have sufficient capacity rights to serve their load, that will drive up the price of capacity rights high enough to ensure that there'll be adequate capacity. And so that's the theory there. The problem is it's not entirely clear right now that either of those methods is going to really work satisfactorily. The energy-only markets has a lot of unpredictability associated with it, and in addition, there's a real question about whether the rules are being applied in a way that's consistent with the theory, because in some of the areas where we most need new generation in Texas, there's been a tendency to impose price caps which limit the return for the generator, and it's potentially a problem. And in the capacity right markets, there are other approaches that are going on, such as the New Jersey approach of separately to generation, which are essentially might undermine the value of capacity rights. And bottom line, from an end user standpoint, is that this is a really important issue. As we've seen in Texas, if we have capacity deficits, that's the one thing that could drive prices back up and potentially drive them up severely. I think probably everybody's familiar with the really painful thousands and thousands of dollars per megawatt hour that we've seen in ERCOT more than once over the period of the last couple of years. Really scary. You can pay more for energy in 16 hours than you pay in a month if the prices spike high enough. So that's a huge issue. And we've got to find a way to strike a balance where, on the one hand, it's an approach that keeps costs down for end users, and on the other hand, we don't run into capacity deficits. And I think end users all have an interest in following this debate closely. I think it is, a real challenge. It's have kind of a hybrid system that's partly free market and partly regulated, and that's not necessarily an ideal model. And I think we all have to put our thinking caps on and figure out approaches that will really work prospectively. So I want to flag the issue because that is the one really major potential risk factor that's out there. If we go to the next slide, with that general background, I want to talk for a minute. Really kind of, to me, as a guy who's worked both on the power side and the natural gas side for my whole career, and seen how it all evolves over time, what's really fascinating is that what we're seeing in a way that, frankly, I wouldn't have personally imagined even 3 or 4 years ago, is that the operation of the grid is changing completely. And it's partly, obviously, that we're using a whole lot more natural gas, and it's partly that we have this competition between natural gas and coal that's driving down profits for the generators, but is keeping driving prices lower for users. But it's also partly, if you look at what's happening on the ground, that the coal units are being used in an entirely different way than they tended to be used in the past. Generally, historically, coal units, most of them were base load. You turned on you kept them on. They operated at close to the same capacity factor all the time, except when they were down for maintenance or had or tripped from forced outages. And there were some units in the generating fleet that where you cycled the units, you varied the output somewhat in order to follow the changes in demand over the course of the day and the week. But each units, you had a pretty high minimum load factor. Now, those rules apply. I don't want to suggest that they're out the window entirely, but what we're seeing is that what the generators are doing in this situation where natural gas prices are real low and natural gas is underbidding coal a lot of the hours of the year, is that they're starting to use the coal units in a much more flexible way, where they're shutting them down much more often, where they're cycling them to, when they're on, they're cycling down to lower load levels. And they're really fundamental changes. We're seeing some of the workhorse-fired units all over the country that historically, from the beginning of time, from after Thomas Edison and created the first distribution system, were run flat out, that are being used even as peakers. First Energy just announced, for example, that the Samist unit, which is a huge unit in Ohio, I can't remember whether it's on Ohio or Pennsylvania side of the border, so I was struggling with that a little bit, but which has been a core part of First Energy's strategy for serving the market, doesn't work as a baseload unit anymore, and they're taking this kind of core asset, and they announced publicly they're going to use it more as a peaking unit. And you're seeing those sort of really major changes in the way that the generating assets are being used. And because that's what has to happen in this market where coal and natural gas are in competition with one another all the time. So, that's the depth of the change. If we can go to the next slide. One way of representing it is you can look at what's happened to the dispatch order. The concept behind the dispatch order is that you need to have enough generation operating every moment of time in order to be able to balance supply and demand. Demand much higher in peak hours than off-peak. You're all familiar with the swings that occur. On the left is the historical type of dispatch curve, and you're seeing the nuclear, and if you look at the far left, you're seeing the nuclear and hydro, which have very, very small margin operating costs, and then see a long string of black, which are all the coal-fired units. And historically, you had to get load higher than the last coal-fired unit there in order to need to use natural gas. And look at the right, that's what's changed. And what you're seeing is some of the coal units are still low cost enough to be dispatched, but some of them are all the way at the top of the curve, and a lot of the gas units are cheaper than coal. Now, essentially, a lot of the estimates have been done of where prices are going to go. Stop there and look at the dispatch curve and try to predict prices on that basis. We've done a lot of work this year, including an awful lot of really in-depth production cost modeling work, and we've looked at the hourly data for the dispatch of every coal plant and every natural gas-fired plant in the United States over the last 4 years to see how things are changing. And this dispatch curve is really just a starting point, because when we're talking about the operation of the grid, it's very much dependent on what's going on at every specific geographic location and what power plants are available to serve load in those locations. So it's really more complex, and you have to use new tools to look at it. If we go to the next slide, we developed some new analytical tools to try to address that. It's taken us thousands and thousands of hours, but we think we now have pretty good transparency both as to what has been happening and what's going to happen in the future. And if we go to the next slide, this kind of shows conceptually what's happening, and essentially what's happening is, we had in total, over the last 4 years, the total supplies coming into the U.S. market have increased by 3 trillion cubic feet a day. I frankly would never have believed you'd have that's roughly a little 15% increase in total supplies. And that's why we have this huge amount of excess natural gas, Essentially, what happens in the market is that where prices clear depends on how much excess natural gas you have to absorb. And if you look at the graph on the left and start at the top bubble and start to work down, essentially, over the past 6-9 months, the amount of excess gas has been somewhere between the bottom bubble and the one just above it. And so essentially, if you follow the track of the arrows from the top of the bottom to the bottom and look at the price scale on the left, prices have to fall and fall and fall to the point where they've absorbed an amount of gas that was right towards the bottom end of that scale, and that's why prices have been exactly where they were. In terms of protections for customers, if you look at what have to happen for prices to rise, if you look at the graph on the right, essentially all that excess supply has to be worked off. And it's such a huge amount of excess supply that that's not particularly likely to happen anytime soon. And if we go to the next slide, what's still true, though, is that, how much excess supply is a function of two sorts of things. It is a function of production, and we'll talk about that in a minute, but it's a function of a lot of other things. It's really a function of weather, and weather can cause the difference between kind of the lowest likely weather demand and the highest is 1.8 trillion cubic feet over a 12-month cycle. And if you have high, very strong, very mild weather, you have even more supply to absorb. If you have very harsh weather, you have less supply to absorb. So the way we think about the market, basically, is that we start looking at the base case. The base case that's used here is it's a language that we all can easily understand. We've used as the base case all EIA estimates for supply and demand. And what they tell us is that if weather is completely normal, and a bunch of other things are normal, our estimates show right now that natural gas prices would be, that what it'll take next year to absorb the excess natural gas will be somewhere around $3, just a little bit above that. But, here's the but that's critical. That depends on a lot of things, and I think you're all familiar with the list. The weather is clearly the most important. Nuclear availability will be very important. And last year, the nuclear units performed they performed in 13 years, and that's soaked up. It was surprising in a lot of ways. We've been used to having virtually all the nuclear units humming at 100% all summer long. This time, we were down, 10, I think it was 11 or 12,000 megawatts out of 110,000 megawatts at some points during the summer. That used up some of the excess natural gas. If those units come back by next year, all the things being equal, it would mean we have more to absorb and lower prices. Hydro availability also has a huge impact. Another thing, which is part of the reason that I'd want to lock in my supply before in the next few months, where a lot of things may come together well, is that in addition to the issue of whether we have adequate capacity, the other real wild card is drought. And as we're all familiar, we had kind of stunning drought this year. I remember seeing pictures of the riverbed of the Mississippi River. They show the Mississippi River, and you'd see riverbed 2 blocks or more on either side. And that has two effects. I mean, we weren't that far away from barge traffic on the Mississippi River stopping, would cause all sorts of disruptions. But in addition, when you have drought, you have to save water. Power plants, coal and some nuclear plants are some of the large, they account for an amazingly large percentage of total water use. You have to start ratcheting them back, and you have to ratchet them back at the worst time of the year, in the middle of the summer, and that can cause prices to go up. And so, frankly, I want to act quickly enough, I'm concerned enough that the drought will continue, that I want to act quickly enough so that I'm not exposed to the risk. It may only be, 1 in 20, it may be 1 in 10, maybe it's 1 in 15, I don't know. But I don't want to take a risk personally of not having my supplies locked in at the time next summer, because we could get a reoccurrence, and that could cause prices to shoot way up. We think the way you have to look at it it is that you have to look at different scenarios in terms of weather and what happens, and that you can get a wide range of price outcomes depending on what happens in these various factors. And what we try to do in terms of the tool that we've developed is that it allows you to say exactly, and we have 5% harsher weather, what happens to prices? If we have mild weather, what happens to prices? And we think because we're in it's kind of ironic, because we're in a coal displacement driven market, if you know in advance or you want to estimate what the excess supply is, you actually can predict what the market clearing price will be with a whole lot of precision. You have to develop whole new tools to do that, but we can do that now, and so we can provide really good insight and transparency as to what could happen with prices, and you can see real clearly, what the factors are. You wait if you act now, or you wait, in both upside and downside. If we can go to the next slide, that's the core of how the market is working now. The long-term question is where will prices go long-term. The graphic on the left is from Pickering, and it's showing the current natural gas supply curve, and what it's showing basically is there's a lot of supply. If you look at the left-hand side, we're getting increasing amounts of supply that cost zero. And the reason they cost zero is that the wells are being drilled for liquids, and natural gas is a byproduct. And as long as the liquid prices are high enough, they're going to be drilled no matter what happens with natural gas prices. And then we have another source is Haynesville, for example, that's below $4. This Pickering estimate it's like $3.65. There are actually two producers in Encana and Fayetteville. Encana in Fayetteville and Southwestern. Encana in Haynesville and Southwestern in Fayetteville that say they can make money in dry gas only plays at $3. And so I think what's going to happen is that supply curve is going to keep on going lower and lower. And more good news. And the question really fundamentally is how much lower does it need to go? And I think I'm going to, so we save time for questions, I'm going to stop with this slide and be glad to take email questions if there are other issues that arise. But the bottom line is essentially that longer term, I think what's going to happen is that there's first of all, that the curve is going to come down. That, today, once you get to 450, that it unlocks huge amounts of supply, and it creates a situation where it's going to be difficult for price to go a whole lot higher. And that curve is going to come lower. So rather than it being 450, 3 years ago, it wouldn't surprise me. 3 years from now, it wouldn't surprise me if it were 350. It could be even lower. So the curve's going to go down, and that's going to, when we look at how the market functions, that's going to mean that if things tighten, got time, whole switching is going to prevent prices from rising very much. If they start to rise and storage starts to go down, we've got a storage cushion. If the cushion starts to go down, we can ramp up production further pretty quickly. And so I think that's good news, because I think it's going to make it difficult for prices to rise farther, and it's going to bring the curve down. And it's even, essentially coal prices I think will stay under pressure, and that will reduce the break-even price for coal displacement, and so that will tend to constrain prices. And we've got all those factors that are going to give us a huge amount of more protection against price spikes than we had in the past, and continue over a longer enough period to bring the overall price curve down. We also will have periods where the industry, the natural gas producers, will tend to overproduce, or there will be mild, or a bunch of other things happen where the market to balance that will have to go back down that bubble chart, and prices will, for both electricity and natural gas, will drop even further. So that's an overall picture. I'd highlight two things: the drought risk next summer, but even more the issue we really need to have adequate incentives for new capacity, because that's the one fly in the ointment that could cause severe problems going in the future. It adds a cost, but it's the only way prices will stay in moderate range long term. We don't want continuation of the kind of price spikes that we've seen in ERCOT. We don't want ERCOT, and we don't want to see them in other regions of the country, and we can only protect against that by making sure that the rules addition of enough new capacity. So that's quick overview of what's going on in the market and how the function has changed. And I think we have time for at least a few questions. And again, I invite you to email if you have additional questions, because we've actually had a whole lot pop up. And I'll look at some of the ones. The first one I have here is what percentage of total Saudi oil BTUs that reduced over the last 20 years were purchased for use in the U.S. I'd have to go look at the data to tell you for sure. My best guess, I think the maximum Saudi imports have been in the range of a little over 1.5 million barrels a day, and the total Saudi production has averaged maybe 5 times higher than that, maybe even 6. So I think essentially in the peak years it's been like 1 out of 5, 1 out of 6, and in other years it's been a lot lower. I'd have to look at the total data to give you a more precise answer. Next question, some coal facilities are going bankrupt, and some experts are predicting coal business will be non-existent in the future. How does this limit the ability to switch to coal? Line, it depends what you mean by the future. If you're asking 20 years from now, maybe. But near term, essentially, to keep the grid up, let me start here. It costs, to replace the entire. I mentioned earlier, I think that it's the next 5-7 years, 85% of the coal-fired fleet is going to survive, and it's about 290,000 megawatt hours of coal. Replacing that, even with natural gas-fired generation, you're talking about, you're starting to approach $1 trillion. And you can't do it overnight, no matter what you do, and you're certainly not going to start construction of $1 trillion of new generation all at once. And so you start to play that out. A lot of the coal is going to operate for a long time. And so when we look, basically, there's next 3 or 4 years, we're actually not going to see a whole lot of change. This is the coal units that are going to be retired immediately aren't being operated that heavily. And so those retirements aren't going to make as much difference as it might seem. Once you get to 2015, 2016, there are more coal units that are going to be replaced by natural gas. I think we have so much production potential that the supplies will just increase to meet that, and that we'll still, at that point, that's when we'll start to be down to only 285,000 megawatts of coal. And there's still, I think, fundamentally, will be plenty of switching capability, particularly because the generators are getting smarter and smarter and smarter and smarter about how to operate their units, and we haven't seen the end of that curve yet. So many generators are operating them differently, but there are a lot that are still not. They'll learn to the ones who are operating them more like peakers now will learn how to do that even better. So the coal companies and the coal-fired plants are going to want to stay there. So they'll do just what the natural gas producers have done. They'll learn how to do their work more efficiently all the time. So I think there's going to be a lot of capability for a long time. Next question, what's up from Marcellus is being supplied entirely by fracking? If so, coal will come back. The fracking process is destructive, and potentially, some people claim it causes more pollution than coal units. I spent a lot of time trying to understand that issue as well as I could, and I'm not a scientist. I'm not the definitive source of information. I think that's one of, and certainly when I give presentations all over the country, that is certainly often the question I'm asked first. I think it is one of the greatest concerns. So I've tried to understand, and essentially, I think it is one of the most overblown issues that we've ever seen. And I will tell you, I've spoken privately with the leaders of every major national environmental group. I've been panels. I've been public with leaders of some of the major national environmental groups, and two things are true. First of all, the leaders always thought it was a manageable problem. And secondly, interestingly, the oil and gas industry, I don't think has really patted itself on the back enough in this area, because essentially, if you look what's happened, there have been really aggressive continuous improvement programs. Even 2.5 years ago, the complaint was that we really needed to do recycling to reduce the amount of water that was used and reduce the potential pollution problems. Well, much everybody's doing recycling now. I mean, the switch has occurred at amazing speed. Some of the recycling, I was at a program in Ohio, spoke on some of the same issues last week on what's now being called Utica/Point Pleasant shale. And the producers said, we're down, we only use up a couple hundred gallons of water that we don't recycle. And so it's always been a manageable problem. The issue has always been in mind the local opposition, and it's probably not going to go away. But if you look at what happened in the end, it really hasn't slowed development very much. And we have so many targets in many places around the country that I don't see it as really having much of an impact. And the last comment that I'll make on this, because this is a really difficult, important issue, and so I don't want to sound dismissive of it, and not. I think, I personally, it pains me that we have this great opportunity to help the economy by using natural gas, and understandably from an end user's perspective, because most of us have the chance to dive into this issue really, really deeply. Understandably, from an end user's perspective, it's a huge concern, and I think it's impeded a lot of users from taking advantage of opportunities to expand industrial facilities, et cetera, et cetera, et cetera, that could really help the economy and allow a lot of businesses to enhance their profitability. And if you look at what's happened and step back, we've had 3 or 4 years now where there's been this intense opposition. And actually, the local groups all over the country, the Department of Justice and others, really eager to say, we got you, and to find episodes. I know I spoke once with Michael Brune, who is the president of the Sierra Club, and his fear, because he recognized that natural gas was really a better alternative, what he said was that we'd have a 3-mile island snaking through the countryside. There'd be problems, complaints about particular sites over and over, all over the country, and that would kill the goose that potentially can lay the golden egg. And it's 3 years later now. And notwithstanding all the people waiting to pounce, there really haven't been any credible claims. Lisa Jackson, who's the head of EPA, has said publicly within the last 3 months that EPA has not yet found a single documented instance of water contamination anywhere in the country. And believe me, EPA was looking to be point a finger. So it's a really serious issue, and I'm not trying to dismiss it or downplay it in any way. But I do think, at least I'm hopeful personally over time that as we keep on going on and on without having any real problems to speak of, that the opposition will fade. And in any event, I think there's so many sources of supply that from an end user standpoint, I wouldn't worry. And I get a last comment. Politically, a lot of people, are just a practical matter saying EPA is going to jump all over this. Well, I think that would have been true 2 years ago. But politics have changed, and we're seeing it in the election now. And also, natural gas from shale has become a centerpiece for the economy. And I think what's going to happen is you're going to see EPA is going to be reasonably demanding, not in a way that's going to affect development. And the costs that it's adding are really very small in the overall scheme of things. So, at least personally, those are reactions. Next question, what impact do you see natural gas exports is having on both price and supply for the U.S. in the foreseeable future? Well, it certainly could have some impact at some point in time, kind of things. One, it's still very unclear whether liquefaction facilities that are needed for exports will be built. There are 2 issues. First of all, what you need is the largest freezer in the world. You need to take natural gas and put it into a liquefaction facility and cool it down to negative 263 degrees Fahrenheit. And that costs a little to change. It's about $2 billion per facility. And there's a decent chance that Cheniere, which has been first in line, will build a facility, but just the cost alone is an issue. Secondly, the second kind of threshold issue as to whether it'll happen at all, there's a lot of concern both about prices rising and also, even if the increase in prices was moderate, it was enormous competitive advantage. How to take best advantage of it. It would be beneficial to be exporting a lot of natural gas. It would bring in a lot of revenues. It would help the balance of payments. And obviously, competitive advantage. This would, to some degree, enhance the ability of the companies who are buying it to continue to be able to compete effectively. They're still going to pay a lot more, though. They're probably going to at least pay double because of the cost for liquefaction and transportation. So that's the second issue. And then the third thing, and the bottom line is, we're going to make it two more. One is timing. And we're talking about realistically, when you hear an announced completion date, it's a target. The targets are financing, construction delays, more likely that if any facilities are built, it's late in the decade. So that's important. And then the final question is supply. And personally, I think when I look at it, even if you had 3 or 4 facilities built, if we back and look at the big picture, then you look at what's happening in Haynesville alone. Haynesville, 3 or 4 years ago, that was the big deal. And it still is a big deal. It still may be the 3rd or 4th largest natural gas field in the world. And now, because the techniques have improved so much, there's more gas there than we thought before that we can recover economically, and actually the prices are going to be way lower than anyone even imagined. But what's happening? There are better places to drill. Haynesville, we went from 0 to 7 BCF a day in roughly 3 years, really only 2009, that we start ramping up production in a meaningful way. And at the time, we ramped it up to almost 200 drilling rigs. And what's happening is that 80% of them have been removed. They've been removed because of any limitation of Haynesville, but because they're even better places to drill. And one of the interesting things is that even though they've been removed, so far production has actually continued to increase a little. Now, it'll go down probably before the end of this year, but it will go down very rapidly. But the main point in this context, and I think this may be about the last question we have time for this afternoon, is that the rigs being removed. The liquefaction facilities, conceivably over 10 years from now, the demand could create 6 to 8 BCF a day of demand. That demand is not going to come as a surprise. It's only for once the facilities have been completed. We're going to have a pretty good handle on when they're going to be completed. Can we supply that 6 to 8 BCF a day without putting significant upward pressure? I think, that if we just think about Haynesville, the answer is we probably can, because if we take the same rigs that we pulled out of Haynesville and put them back in, essentially I think we'll be able to get a large increase in supply just by resuming the process of taking full advantage of Haynesville. And I think the way the techniques have already improved, that's probably more than enough just by itself, and it won't be the only source of supply, but I think it's probably enough just by itself to supply that market, especially because you will have lead time, and especially because the way these plants are usually built is that you get dedicated, you line up the reserves before you even finance them. So, it's a big issue, and there's certainly some possibility of upward price pressure, but I think that's tended to be exaggerated, that the issue is really more, do we keep it all for ourselves or bring in dollars from the exports? I think that's a bigger issue, and I think in terms of what is really of concern to end users, it goes back to the capacity issue. In terms of supplies, et cetera, I think we're going to be in good shape. The capacity is a real issue, and I think potentially the drought is a real issue, which is why I tend to do my procurement a little bit sooner rather than take the summer risks. So I appreciate tremendously. I have a real passion about these issues. I think they're really important to all of us. It's a tremendous opportunity for the economy. I appreciate tremendously the opportunity that SUEZ has given me to talk about these a little bit. And from the questions we've already received, I think there are probably more than a few remaining. And every time I give a presentation for SUEZ, I want to encourage people to, if you have further questions, don't hesitate to email us.
Thank you. Really appreciate your enlightening webinar today. We'd like to end our webinars mentioning that we want to hear from our participants. We'll be receiving a survey, and we encourage you to take 5 minutes of your time to provide us with input on how we did and feedback on what you would like GDF SUEZ to provide in future webinars to come. Once it's available, you'll also receive the link to today's recorded webinar and presentation. We look forward to everyone attending our next quarterly webinar that will focus on sustainability and demand response. Thank you for joining us today. Please call 866-999-8374 for any questions about your electricity needs, or if you're interested in receiving a quote from one of us in the future.